The IMF has upgraded its growth estimate for 2020 by almost a full percentage point due to a stronger than expected recovery in the second half of last year in many countries, including Australia. Joining me now is Peter Switzer, the founder of the Switzer Report, of course. Pete, what do you make of those numbers?
Well, I'm pretty happy about them, Pete, because as you know, I've been a little bit more optimistic than most of my colleagues in the dismal science called economics. And look, basically, the arrival of vaccines earlier than expected have really helped this. Of course, part of the positivity was the fact that Europe really gave up on worrying about the infection problem over their summer, which meant that economic activity in Europe improved. But it does come back to bite them. And I think that countries like Australia have done brilliantly well, and the IMF has actually underlined it because looking at the numbers, and you can't always believe the IMF numbers. They're really hard to get this kind of thing right. But you look to the direction. Are they upgrading? The answer is yes, they're upgrading. So that's very good. And vaccinations are going to be the reason for it. But look at Australia. They reckon that we will be back to our pre-coronavirus level of economic activity sometime this year, where the UK and Japan, they're saying 2022, 2023. So it's an extraordinary performance by us. And I think I also think it's quite unusual, Peter. This country and the people in it are often described as being larrikins, but we've been goody two-shoes. We've done as we've told, and as a consequence, the infection rates are low and the economic dividend has been high.
Yeah, well, what about company profits set to spike 20%, Pete?
Exactly. City forecasts have come out, and there are significant forecasts in this country, and they reckon that we're going to have a 20% rise in earnings per share. Resources sector are going to swell by 32%, and that's why the dividends are going to be so strong in that area. And then you've got the benefits of the energy sector now taking off. Woodside is now, around $25, $26. When you and I first started talking about...
Well, mate, that was quite a run on Woodside, wasn't there? Was it about a month ago? It took off.
Yeah, and you got in, didn't you? But you thought I was wrong for a long time, didn't you?
Sweating bullets, I was, Pete.
What does this guy know about stocks?
Exactly. Yeah, but so the key there is for investors out there, and it's buyer beware, of course, but maybe follow the resources energy stocks for the next little while.
They're really well priced, Peter. And I think the dividend is going to be they will pay good dividends. But I think the bottom line for this year is that cyclical stocks are going to do very well. They're stocks that are linked to stronger economic growth. And remember, the miners, they sell stuff into an improving global economy. So our first story about the IMF saying that the global economy is on the pickup, that's going to help cyclical stocks. And that's why banks have done well as well.
Yeah.
They've struggled for so long. They're going to start seeing people demanding money. High interest rates will eventually start coming back. All good for bank bottom lines. But we'll be on the lookout for those cyclical companies that have been ignored so far. And by the way, some of those, I guess, will be the travel stocks, but they're not really going to have their second takeoff. They've already had one in anticipation of improvement, but the second takeoff won't come until vaccinations are really in place and they're talking about us flying overseas. When that happens, I think the web jets and the flight centres will really have another leg up.
Yeah, and that might be a while off, though.
Yeah.
But Pete, just finally, BlackRock, interesting comments today. Companies must be prepared for a global carbon shock.
Yeah, and what they're basically saying is there's about 8.7 trillion US dollars out there in the investment pool that's going to be heavily swung towards companies that are believers in climate change. And basically what they're saying is there's a real threat to the potential profits, and then the share price of these companies, they will be dumped by a lot of the big fund managers because they haven't adopted climate change type policies, and as a consequence their share price will fall because the fund managers are the biggest buyers in town. So whether you believe it or not, if the big end of town and the big corporations believe it, it's going to happen.
All right, got 30 seconds left, Pete. What's the forecast from the Switzer report this year? A key stock to watch in your opinion?
Yeah, okay. I like stocks like Afterpay and Zip. Afterpay is really
still Afterpay.
Yeah, I've got a funny feeling Afterpay is going to keep going well.
Really?
It's just, you know what, I discovered
it's too expensive for a lot of people now, though.
Exactly right, and that's why maybe the second one back, Zip, might be the one. It has what we call the halo effect.
Which one's that one? Zip.
Zip,
right.
Zipco, and that's the sort of second tier one. But
Right.
the thing is this, Pete, Afterpay is doing well in America. Apparently, only 1% of Americans are into buy now, pay later. So as they become more normal, like Australia, you're going to see all the companies in that space doing well. So, but look, next week I'll come up with the gun performers.
Let's tease it out for next week. All right.
We'll
I mean, I would have thought Afterpay already $150 a share. It's I mean, where can that go?
Yeah. I must admit, I'm not buying at these levels, but this is the word on the street. It's a company that will do better than we expect.